Hi, and welcome to our end of February update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. And thanks again for the feedback this past month. As you see this month, I've been getting feedback that words on my slides are relatively hard to see when I use a relatively dark background, like the soothing blue-green background I used to use. Hey, I'm a radiologist. Radiologists love to spend time in dark rooms reading white bone on dark background x-rays. Anything with bright whitish background tend to hurt our eyes. But I realize now that videos on YouTube aren't always scrutinized in dark rooms free of distractions. I'll try this lighter background this month. Let me know how this works for you. So, we come to our question, or rather group of questions this month. This month centered on topic of mutual funds. I don't know, I started out with mutual funds, so I find them pretty basic. But this isn't about me. This is about getting you up to speed in terms of understanding what the heck we're trying to do when we're investing in the markets. So, apologies that my talks about mutual funds and ETFs may have gone over people's heads before. It is an interesting and important topic to get handled. So, questions such as, what is an index? What is a mutual fund and how is it different from exchange-traded funds or ETFs? And why do I interchange them in the way I do in my videos? When would using one over the other be better? What the heck is a Vanguard Admiral Fund and when should I use it? And how come some people use the Vanguard Total Stock Market Index Fund instead of the S&P 500 Index Fund? Can I use the Total Stock Market Index Fund instead? I've heard advisors say dimensional funds outperform Vanguard funds because they have low expense ratios and tweak the strictly indexed model of the Vanguard index funds. How do they work? Can I use them instead? All good questions. So let's step back again and let's pretend we're sitting outside on this street in New York City called Wall Street in 1884. Wall Street was a place outside that was large enough for people to gather around to buy and sell each other's stocks. At the end of the trading day, if we asked someone how they did that day or how did the markets do in general, we would get a blank expression. Well, some stocks went up and some went down. It wasn't until 1886 when the Dow Index was first published. At that time, 30 representative stocks were selected and rated. Some went up, some went down. A couple may have gone up or down a lot. And all the ups and downs were added together until the sum, or the index, was a net up or down. It's useful to know that if the index went up, chances are most of the stocks you own probably went up. Whereas if the index went down, you probably lost money that day if you owned stocks. But wait. What if a big company like GE went up, yet a bunch of smaller stocks went down? Well, a big company like GE means more people probably own GE than the smaller stocks, so GE counted more. I'm not picking on GE, and in no way am I recommending GE. I'm just using the hypothetical 1886 GE as an example that if a big company went up, we multiply the stock by size factor, then added up all those price movements adjusted for size factor. This size factor is known as market capitalization in financial lingo. Learn the lingo, learn the topic. So the most popular index for the US stock market would be the S&P 500 index nowadays, made up of the 500 largest representative stocks adjusted for market cap. So this is where the term index fund comes from. A mutual fund tries to do well. Well, what does doing well mean? Well, when stocks go up and stocks go down, the stocks that the mutual fund picks might all go up, but did they do well? What if the index went up more? Then the stock market mutual fund didn't do as well as the index. The index serves as an internal reference point to measure the effectiveness of an investor, stock picker, or mutual fund manager. If the index tends to beat most fund managers 70% of the time in any given year, as they have in the past, might as well invest in a mutual fund that invests in the index itself. So what's an ETF? An ETF, or exchange traded fund, you can think of like a mutual fund that trades directly on the stock exchanges. There are only a set number of shares available for trading, so these funds can literally just buy stocks or whatever securities they're supposed to buy and then just sit on their hands all year. Thus, lower fees, because they don't have to buy or sell stocks or bonds whenever someone buys or redeems shares. Also, let's say we're supposed to buy one fund and sell the other. If the fund we're selling is going down that day, we get to sell the fund before it gets to a low of the day, at the end of the day. And if the fund we're supposed to buy that day was going up, we'd get to buy the fund in the middle of the day before it reached the high of the day. With mutual funds, we don't have that luxury because mutual funds settle at their closing price at the end of the day. And yes, if you're guessing that we're supposed to sell an ETF that's rising that day and buy an ETF that's falling that day, we get worse fills than the mutual funds, you'd be right also. And yes, if you're guessing that we're supposed to sell an ETF that's rising that day and buying an ETF that's falling that day, we'd get worse fills than mutual funds, you'd be right. So here's a table that summarizes a few of the key differences between mutual funds and ETFs. They're both portfolio of investments in that they can hold stocks, bonds, other equities, and other derivatives. Mutual funds can be more flexible for those of us who have busy daytime jobs in that we can place orders the night before and count on the fill the next day. However, the fills may not be optimal because funds use end-of-day prices only. Plus, mutual fund companies frown on buying and redeeming shares more often than once every 30 days, 60 days, 100 days, or whatever, depending on the mutual company. Mutual funds have higher minimum balance requirements. What I like about mutual funds is that the key benchmark funds have a lot more historical data for me to backtest strategies. Because my backtests are based on benchmark mutual funds, I use these same benchmark mutual funds to base all my calculations each month. So, the mutual fund tells me which asset classes to buy or sell this month, and I physically perform the corresponding transaction using the mutual fund's equivalent ETF. ETFs are just so much easier to trade, have lower minimum requirements, have no penalty for frequent trading. In fact, some people day trade these things. Although, for those of us in the US, you may have to keep in mind the 30-day wash sale rule for tax purposes. So, what's an Admiral fund? Admiral shares are a special class of mutual fund shares from Vanguard. For instance, the VFINX S&P 500 Index Fund, that's so famous and that I love to use for benchmark and demonstration purposes because it's been around so long, has a corresponding Admiral fund, the VFIAX Admiral share version. Admiral shares were created by Vanguard to reward high net worth clients with funds with low expense ratios in exchange for higher minimum balances. For instance, it only takes $3,000 minimum to buy the VFINX investor shares, but $10,000 minimum to buy VFIAX Admiral shares. And yes, the 0.17% expense ratio of the VFINX, although it's already extremely low, is one-upped by the 0.05% expense ratio of the Admiral shares. Now keep in mind, already these are low. Mutual funds can range up to 5% expense ratios, just as reference point. And the ETF version of the index fund, the SPY, has an expense ratio of only 0.09. Okay, so this is all well and good. They bribe you with low expenses to get you to invest. Sounds great in theory. So what's the data show? Those of you who have heard me talking about any investing scheme is, show me the data. So I backtest this Admiral share theory. The VFIX was only started November 13, 2000. Let's test this out. How much more gain can we get by saving 0.12% in expenses? Well, here's a graph. They're virtually identical. Over the last 14 years and 3 months, the graphs overlap so much, you can't tell the difference between the two on Excel spreadsheet. To get any meaningful difference between the two, I had to go 4 decimal points to show how little these two funds differed over 14 years. Said another way, if you started with $10,000 in November of 2000, you get $20,808.76 with the Admiral Fund, whereas you get $6.50 less with the Joe Schmo Investor Class VFINX. Whew. And if you're guessing we get similar performances with the SPY ETF, you'd be correct as well. So, what's this total stock market index fund? Vanguard's website describes it as diversifying over the entire stock market, not just the largest 500 companies. In theory, because we're really diversified, we get exposure to those smaller cap stocks that have greater potential to go up than those big stodgy stocks. Again, what's the data show? This total stock market index fund, the VFINX, has been around since April 27, 1992. So, over 22 years, 10 months, the graphs are barely distinguishable. Look, the blue line, which is the VFINX, barely peaks above the red line here in February. As you can see, there's a bigger difference between the two, a whole 0.1% average difference annualized. But over almost 23 years, had you invested $10,000 in 1992, you'd end up with $80,242.06 with the total stock market index fund, which is a little bit more than $1,000 more than if you invested in the S&P 500 index fund. So yes, small differences in cumulative average gains does magnify over time. So what about dimensional funds? I'm not going to knock other funds. These funds are low cost. Expense ratios are down to 0.08%. They're not called index funds because they do tweak the passive index model. For instance, let's say the Standard & Poor's announces that they were going to drop the 4 smallest or worst performing stocks from the S&P 500 index and replace them with 4 other stocks. Guess what? Anyone with this knowledge of a known future event will want to both sell the soon-to-be dropped stocks as well as buy the soon-to-be included stocks because they know that when the date hits and the change in index happens, all the index funds in the world must sell those 4 stocks and must buy the 4 new stocks. It's basically a free ride. Dimensional funds get to proactively exchange these stocks as well, without the constraints of being an index fund. So, does a DFUSX, the dimensional fund, beat the Vanguard index fund? We only have data since they were made available in September of 1999. Again, here it is. Virtually identical graph. Again, the blue line barely peaks above the red line in February last week. You get the idea. The big takeaway from here is if you're going to the buy and hold model, it's tough to beat the index, and even then, you might be able to beat it by a smidgen. Whether or not that means you like to own one of these alternatives would be a personal choice. So, on to our monthly update. Yes, the S&P 500 index is still above the 20-month moving average. Still safe to stay in stocks. Next. And remember, the 20-month moving average system has nothing to do with this MRI monthly rotating investing system. Nothing to do with it. This is a completely different system. We're ranking these 3 funds. And again, this month we have a clear winner. That's this blue line, the VFINX, the SPY, the S&P 500 index. The model this month is to sell the bottom 25% and buy the S&P 500 index. Now, recall last month we were half in the inverse fund and half in the index fund. This month, if we sell one inverse fund and buy the one index fund, we still have one inverse fund which cancels out one index fund, which essentially means you can be half cash, half index fund and still be equivalent to this configuration, saving you a commission. Because last month, if you were all cash, you only had to make one transaction, that is, buy half of your portfolio in the index fund and using only one commission. Just a little tweak or a nuance. Now, dollar cost averaging. Just a reminder, those who have not yet made your IRA contribution, do so. Put time on your side. And finally, the 1% risk trailing stop system. Only you know what's in your portfolio. Monitor them at least monthly. I prefer at least weekly, but that's me. Look at the last 2 months worth of videos for more full discussion of the 1% risk trailing stop system. And until next time, invest safely.